G'day everyone, and welcome back. G'day everyone, and welcome back to this ShareCafe Hidden Gems webinar. Thank you all again for your Friday lunchtime time. We've got some exciting companies presenting today. Now, this week of note, you know, we always like to give a little bit of an update. This week of note, we saw Lake Resources technology partner invest into their lithium brine project. Now, why is this of significance? Well, their tech partner, Lilac Solutions, has the backing of some of the biggest name investors around the globe. This included Breakthrough Energy Ventures, which is a non-profit venture by Bill Gates, and investors in that include Jeff Bezos, Twiggy Forrest, and Michael Bloomberg. Now, another investor is Chris Sacca. Now, he's the managing partner of Lower Carbon Capital. You may not know him. He looks more like a country and western star than anything else, but he's a very successful early stage investor. He backed Twitter, Uber, and Instagram, to name a few. Now, the significance of all this for investors is that big name investors are now backing environmental technology. And we see this as a space as the equivalent of the technology early days. Interestingly, Perennial Value spoke about this in their recent investor update. Now, the trend is the same in Europe, where $120 billion flowed into sustainable funds in the first quarter of 2021. By comparison, Australia's entire sustainable investment universe accounts for only $25 billion in assets under management, and over half of that's in passive ETF products. Now, the driving force of this fund flow into Europe is that they're legally bound to, they've got net zero emissions by 2050. That is part of their regulations moving forward. Now, this has created a roadmap moving forward for investment, technology, and infrastructure. Now, by comparison, Australia does not yet have a commitment to net zero emissions over any time frame and currently ranks last out of nearly 200 countries on climate action, according to the United Nations. Now, according to Perennial Value, and I find this hard to believe, in Victoria, drivers at the moment are in fact taxed per kilometre for driving electric vehicles. So there needs to be some more policy action, and investors also have an enormous part to play. Australian asset owners are slowly progressing their sustainable investing agendas. But of the $4.1 trillion invested across managed funds, only half are in sustainable funds. Now, the reason for this is this misconception of poor performance. The irony being that the average of all responsible investment equity funds outperformed the S&P ASX 300 by 1% over 5 years and by 1.2% over 10 years. And given this space has now attracted the attention of the world's billionaires who have just effectively backed a tech investment into an Australian lithium company, it's time to watch this space. Okay, first up today, we have the agency. Now, don't forget to ask questions. All these webinars will be online next week. We have the agency up first, ASX code AU1, market cap around $23 million, a one-year return of 57%. The agency goal has been to support and add value to the day-to-day lives of clients interested in property and wealth creation. We have with us the CEO, Geoff Lucas. Geoff, over to you. Thanks, mate.
Thank you very much, Tim, and thank you everybody for taking a little bit of time to listen to my very brief update on the agency real estate group. Tim mentioned, my name is Geoff Lucas. I'm the group CEO, and I've been in this role for 6 months. Prior to this, I was the CEO at McGrath, which is a similar company in a similar space, but I'll run through the differences that our particular business model has to the vast majority of the industry. The reason I'm here is because I saw that the founders of this business came up with a vision and a model that was different, and we think tailored to what the needs of customers and agents are going to be moving forward into the future in this rapidly changing environment. So let me just walk through these slides very briefly, and hopefully we've got some time for some questions afterwards. Thanks, Tim. We like to start with this to talk about the size of the industry. I'm excited about working in this industry because it's a big industry. Up the top there, you'll see that the assets in this industry are worth $8.9 trillion. Now, that's grown significantly over just the last couple of years. It was circa 6.5 to 7 trillion just 24 months ago. But the rate of change is interesting. The most interesting thing is, I guess, the relativity of size of this asset class. You'll see on the right-hand side here at 8.9 trillion, we're some 3 times the entire Australian superannuation industry, and also some 3 and a bit times the ASX as a whole. Compared to the commercial real estate industry in Australia, we're a staggering 9 times the size of that. So what does that mean for us and for you as investors or potential investors? Well, it's the total addressable market that we're after. Really, that's the commission income that comes from the sale of these houses. We had about 600,000 sales in the last 12 months, as you'll see in the hexagons on the left, and that generated a gross value of approximately $411 billion. If you multiply that by the average commission rate of 1.3%, now that's not the commission rate in the markets that we generally operate in. We're generally between 1.7 and 2%. The Australian National is somewhere around 1.3%. That gives a total fee pool, commission pool, or total addressable market of $5.3 billion. That's what we are looking to gain an increased share of. Currently, the business has been in existence for just over 4.5 years, and we currently account for just short of 1% of the market share. Now, to put that in perspective, highly fragmented industry, which also gives us cause for great excitement, for opportunities for consolidation and growth in market share. Ray White, probably the market leader, some 800 to 900 offices currently, probably about 9.5% market share. Then it falls away very quickly. The numbers 2, 3 and 4, people like Bell Property, LJ Hooker, Rain and Horne McGrath, each having somewhere between 2 and 3% of market share. So sitting just short of 1%. And with the executive team I've got here that I've worked with before in gaining market share, we're quite confident of gaining increased share in coming periods. Thanks, Tim. So this slide, a lot of information there, but basically in a nutshell, it's talking about why we differ, and I'll quickly walk you through that. You can read that at your own leisure. The Australian industry has predominantly been populated by franchise businesses, Rain and Horne, Ray White, LJ Hooker and the like. That's the vast majority. So small businesses, franchisee businesses. In that value chain, you've got the group up here, the Ray White group, for example. Then you've got a franchisee here who, and then underneath the franchisee, you've got the real estate agents who generate the commission. The franchisee, they take a leakage of value out of that value chain, and they're entitled to it because they've invested their time, effort, intellectual property, entrepreneurial skills, etc., and they take a leakage of that value. We've removed the franchisee. So we go directly from the agency to the agent, and to both us, but also the agent. So we're able to pass on higher splits of the commission, and I'll show you a chart in a moment, higher splits of commission to agents. Agents are attracted to that, hence the attractiveness of our model. The other thing with our business model is we don't believe in retail offices. We don't think people go to real estate offices anymore to transact property. They do it largely here. They do it face-to-face in the marketplace. Moreover, we operate what we call hubs, and we've got 6 of those around Australia at the moment. And those hubs are not street front, and they don't have $1 million fit outs, and they don't have glossy brands all over them, but they're highly functional and appropriate facilities for our agents to come, have their sales meetings, collaborate, and then disseminate out into their respective marketplaces. We think that's the future of how real estate businesses will operate in the future. And that's been exacerbated by COVID, and we've seen more and more. I mean, the industry during COVID has been really hardly even lost a beat. And we think that that's actually accelerated that style of doing business. Stabilised our balance sheet, and I'll talk about that a little bit later. We're a vertically integrated business. We see some 500,000 plus people face-to-face that are open for inspections across the country every year. So we figure that it's an opportunity to actually offer those people who are buying and selling property ancillary or adjacent services. And to that end, we have businesses that accommodate mortgage broking, settlements, also property management, and also conveyancing services. So we're starting to provide ancillary or adjacent services, and we see great opportunity to broaden those and to offer further adjacent services as well. We've had some strong macroeconomic tailwinds, notwithstanding the challenges of COVID. We've had low interest rates. We've had limited stock on the market. We've therefore had high prices. And we've seen days on market come down so that the industry has increased the number of transactions in the last 12 months by about 40%, notwithstanding COVID. We've built the business nationally. That's quite unique. We've got a very scalable footprint, and we're currently operating in Western Australia, New South Wales, Victoria, and Queensland, looking to grow the states, but also looking to grow our market share within those states. Thanks, Tim. This slide here just really highlights what I was speaking about before. Over on the left-hand side, you'll see the traditional franchise model. The vast majority of the Australian industry is structured this way. The franchisor takes 10%, the franchisee left with about 40% to pay the costs of their offices, etc. And the agent generally takes 50 to 55% of the take. Across on the right-hand side, independent operations. Again, the principal in their expensive offices takes 40% and the agent has 60%. In the middle is the agency. Now, we're an agent-centric services business. So you'll see there that the agents in our business take a split between 65 and 85%. We're able to do that because of the model that I discussed before. We're also able, through our scale, to offer very efficient, effective back-end services. So we make sure that the agents are out there doing the things that they should be doing. They're salespeople, and we look after an efficient back end for them. Thanks, Tim. How did we go last year, financial year 21? It was an exceptional year for us. Now, we're not here to generate an EBITDA annually of $4.6 million, but it was important because it's only in the 4th year of the operation of the business. And we built a scalable business, so there's significant infrastructure there, and the revenue needs to cover those costs. Last year was important because we actually did that and had some surplus, and so we're in momentum, and you'll see that with some of the other numbers. So the benefit there is as we continue to grow, and we should continue to grow and attract more agents and grow more market share from our current 1%, more of that return will drop through to the bottom line. And we've seen that in our reducing operating expenses as a percentage of income steadily over the last 3 years. Our GCI, that's the total of the commissions that are earned by our agents that work with us, up 69% on the prior year. Our growth compared to market, I mentioned before, the market grew strongly in terms of numbers of transactions, 40.7%. Not everybody will tell you that because they're busy talking about how they grew, etc. That's terrific, but what we're concentrating on is outperformance of market. That's how we grow our market share. We did 57.7% uplift in transaction numbers, about a 30-odd% increase over the market rate of increase. Worked really hard, and there's a slide coming up on our balance sheet, and we're now in a really strong financial position to go forward and take opportunities as they come to us. Thanks, Tim. Again, this slide here just reiterates the fact that we had 4,964 transactions last year, which was 57% up. We've got the platform. We're ready to now scale further. Thanks, Tim. This is the national footprint that we've got. You'll see that we've got, this is our agent distribution. We've got 155 in WA. We've got 144 in New South Wales, 21 in Victoria, just 9 in Queensland. Queensland, we opened 3 months ago, and we're seeing exceptional rate of growth up there as we speak. So that's the way that we're distributed at the moment and looking for growth in all of those key markets going forward. You'll see up the top the agent numbers, fairly steady growth, 308 to 329 there on that bar chart. We're up about 7% since the 30th of June on that 308. So we're growing quite well, and that's validating the attractiveness of our model. Thank you, Tim. This is the chart I mentioned to you in terms of balance sheet repair. Just 2 years ago, you'll see on the right-hand side that we had debt of $21.1 million, and that was debt that was accumulated from the initial startup of the business and buying some assets, rent rolls, etc. Companies work very hard in reducing that, and you'll see the trajectory of that versus our EBITDA. We had negative $4.2 million in that year. Now that trajectory has improved significantly, and you'll see in FY21, we've narrowed that down to $8.35 million in debt and against a $4.6 million EBITDA. That trajectory, certainly of the EBITDA, we like and will continue to work on. We think that it's useful and efficient to have a modicum of debt, and perhaps that's circa $5 to $8 million going forward. It's backed by assets of about $25 to $26 million. Thank you, Tim. So what are we seeing at the moment? We're seeing at the moment pretty strong pipeline of listings. Post-COVID, there's a lot of positivity, and we're seeing lead indicators like comparative market analyses that agents are requesting through CoreLogic. They're starting to lift, and that's a lead indicator for more property coming on the market. What does that mean? Probably demand and supply moving more toward equilibrium. Good thing for steadying price growth. That can't go on forever. Good thing also for numbers of transactions, because we see a slight increase in numbers of transactions coming forward in future months. We're continuing to recruit agents very well. We think that we've got a compelling offering to them, and that's shown in our strong recruitment numbers. And we're obviously concentrating on building that market share from our circa 1% at the moment. Our strong financial position, we've built now a financial position, a balance sheet that puts us on a very steady platform to go ahead with, you know, the inevitable consolidation of the industry, which we would like to lead. We think our business model allows us to do that, whereas the franchise model doesn't necessarily lend itself to that. Thank you. Just a very quick slide on the structure of our shareholding. You'll see there 30% is Peter's investment, our major shareholder. They also hold a $3 million convertible note. Daring Investments at 5%, we're a founding shareholder. Directors and management hold 8%. Founding agents, healthy 16% amongst them, and then a free float of 41%. Moving on to the management team, we do have a very, very strong and experienced management team. We're not there with that strength and attendant cost to be this size of a business. We've structured ourselves to be a very much larger business, and we've got the right people in the right place to do that. And we think that we're quite unique in regard to that. So we're well positioned again to drive further growth in the business. That's the end of the very quick presentation. I'd love to see if anybody's got any questions for me, please.
Thanks, Geoff. Just a quick question here on what's stopping other agents kind of replicating this model? I mean, the reality is people are working at home these days, so having a physical office is obviously part of your model, but what's to stop Ray White doing that and kind of copying this sort of model?
Yeah, and so the existing franchise structure of the majority of the industry, they've got legacy issues where they've got franchise agreements of 5, 6, 7, 8, maybe 10 years in place. And so it's very hard to turn those big ships around in a nimble manner. The other thing, of course, is if you go back and have a look at the capital that was invested in this business from the outset, you know, there's a significant amount of capital that was poured into this, and we've only just got to a point where we're starting to cover over that and produce positive EBITDA. So there are barriers to entry. We do actually operate a secondary brand, which is a lower service offering, and that's for a different type of agent. And so we protect ourselves there by participating in that market as well.
And kind of looking forward 1 to 2 years from now, I mean, we're in a real sweet spot for real estate. What does the EBITDA and profits look like?
Yeah, so we don't issue guidance, and 544% year on year is pretty unsustainable, I think. But we'd like to think that we're going to improve our EBITDA. How's that as an answer? You know, I gave you a figure before of 7% growth in agent numbers. They take a little while to become productive once they come on. We'd love to think that we could annualize that growth, and if you extrapolate that out, you can start to do some interesting mathematics.
And scale comes from bringing agents on board. Real estate agents move around a bit. How do you kind of keep a hold of those agents?
Yeah, great question. And so you'll recall that I was talking before about an agent-centric business. So we're able to actually, first of all, offer them a higher split than the majority of people. They simply can't do it because of their cost structures. And that becomes an even bigger moat for us as we get larger and there's more efficiencies. We also offer them a very efficient and supportive back end to get them out doing what they're doing. I guess an analogy is something like the old-fashioned hardware stores that couldn't compete against Bunnings. But just because Bunnings have got that scale, they also got the ability to actually be attractive to the customer through that scale. So I guess that's an analogy that we use.
And just quickly, the industry is cyclical. There's a question here. Is the model able to handle a slowdown of property? Are you protected with your rent rolls and those sort of things?
So rent rolls are important. We've got one of the larger rent rolls in the country. Again, a difference between us and the franchise business. The franchisors don't own these rent rolls. So we have an asset worth about $25 million, 3,500 properties. And if you look at the value of those properties, we're actually we're actually managing assets worth about $3 billion. And so that generates a nice recurring income for us to smooth through the cycles of sales. But of course, one of the best smoothers through those cycles of sales is growth in agent numbers. The market gets tougher, agents look to come to a place where they can get more support. So we think we've built, as I say, a moat that protects us against that and positions us well.
Great, Geoff. That's all we have time for. Have a nice weekend, and we'll hear again from you shortly.
Thank you very much for your attention.
Thank you. Next up, we have Nutritional Growth Solutions, ASX code NGS, market cap around $22.5 million, hasn't been listed for 12 months. The company focuses on the interaction between nutrition and the growth in children. We welcome back Brian Leedman, who is the non-executive chairman. Brian, thanks for your time. Over to you, mate.
Thank you, Tim, and thanks to your listeners for tuning in today. Let's just flip to the third slide, if we may. So this is a number of my companies. I'm the chairman of some other biotechnology companies or health companies, some of which you're probably familiar with, ResApp Health. And I was the founder of Oxford Medical and co-founder of Imaging Limited, which I think is capped at about $1.7 billion right now. So I've had some success with various companies that I've chosen to be associated with. And Nutritional Growth Solutions is certainly one that I'm founding chairman and took that to an IPO in October last year. It's led by Liron Fendel, and it's actually an Israeli company. So she's based in Tel Aviv, and she's a corporate lawyer. She's excellent to work with and really successful in her own right. And we have Professor Renard Shamir, MD. He's also the co-founder of the company, and it's largely based on his work. He's at the major children's hospital in Israel, and that's where the technology was founded. Anton Yavarov is with me here in Perth. He and I co-founded Neuroscientific Biopharmaceuticals together. I was chairman of that, recently stepped off though, and Kaner and Amir are both in Israel. Next. So we're creating scientifically formulated nutritional snacks, and that's effectively we're a marketing play. We've got a number of products that we've developed. Some are already on market, others are in the process of coming on market, and it's all about achieving the optimal height for children. And it works. This is clinically proven products. I'll get into that in a moment. Next slide. We have actually, you know what? I think we actually skipped the slide for some reason. Damn it. I don't know why that happened. I can see it's actually crossed off here. I was going to show you the market cap, but I wanted to mention there, I can't show you the slide, but as Tim said, we're about 20 million market cap, but we've actually got, we did a capital raise of $5 million only earlier this month. So we've got about $7 million in the bank. We're well funded. I just wanted to make sure I got that message across. In terms of the clinical study, it's very important that this slide here, in fact, it's the most important slide in the whole deck. And it actually shows the actual efficacy that we gained in this product. So we're talking about kids who are generally shorter. There were 200 children in this study, and you can see that the kids who were taking healthy height grew on average between 14 and 34%. It was actually about an average of 30% increase in height over the placebo group, which is a phenomenal outcome. And that's really what got me intrigued with this company from the beginning, that these kids are receiving the supplement and growing taller faster than the kids on the placebo. So this is a clinically proven product in a very, nutraceutical space. It's typically products that are all safe, but there's no claims of efficacy associated with any of them. And yet this is a product that's actually clinically proven. And that's certainly the main reason why I would be involved in this. Next. So they're unique. It's all scientifically formulated and clinically tested, patented. We're a marketing play. We're already in the US market. We've moved into Europe. We're moving into China. We're looking at moving into Australia now as well. We've got a range of products and, of course, most importantly, sales. And I'll get to the slides in a moment, but the sales are growing rapidly. So we're achieving record quarter-on-quarter sales today. Next. So recently we launched sales in China and Italy. In Italy, the first half years of sales just straight up was over $500,000 US. So that was a great launch into Italy. We've already now launched a new Healthy Height Nutritional Bar in North America. We'll see the sales come on from that. And also the new Grow Daily 10 Plus, targeting kids who are in the sort of pre-teen age group. That's just been launched. So we're growing our suite of products, which is really important. Just recently, we announced the Chemist Warehouse distribution agreement in China. That was a big announcement for us. And we're also moving our production of the product from the US to New Zealand for the Chinese market. So that's another key growth market for us. And we've also made these new appointments, which I'll talk about. Plus, obviously, the record half revenue, which we announced recently, and that was well received by the market. Next. So you can see that the sales is very important to us. They're growing quarter on quarter. The trend is certainly looking very good. We'll see what the next quarter produces. I'm certainly optimistic, but with the new channels and new markets that we're opening up into, I expect that we're going to continue to outperform going forward, which is obviously going to be a major factor for investors because this company's sales growth is growing dramatically. And I should also say that we've got profit margins in excess of 50%. And we can do that because we're a premium product. We're clinically proven, so that's why we charge the premium. Next. So it's a large market opportunity. You can see everyone knows the infant formula space. It's pretty crowded, but we're in that sort of our own niche, really. It's the kids between the ages of 3 and 13 mostly. That's not a crowded space by any means. It's a great sweet spot for us, and that's why we're growing in that space and entering new markets. Next. This is a validation. The company in 2014 had sold its rights of Healthy Height, this unique formula that we have, for all of India to GlaxoSmithKline. It's actually sold presently under the Horlicks brand. I don't have any knowledge as to the actual sales figures because we sold the outright sales for 14 million Australian dollars. But we do know that the product is sold right throughout India, so it must be a high-selling product for the Horlicks brand. Next. So that's our portfolio. You can see we've got the daily shakes. It's targeted in the 3 to 9 year age group. That's the key one for us. The new products that we've just launched, being the snack bar and the Grow Daily, and also the everyday shake. So we're sort of building this suite of products that's going to allow us to continue to increase our sales. Next. In terms of the expanding sales channels, there's North America is the backbone for us. We're selling effectively through Amazon. That's where we're getting most of our sales, but we also, so that's online sales, but this new distribution agreement that we have with IMCO, which is a leading distributor to pharmacies, private pharmacies across the United States, that's just come online. So that's an important one for us. And we're going to see increased sales through physical sales channels, which is really important for me to not just be on the online sales, but actually physically be on the shelves. In China, the Tmall Global Flag Store is the one that we're selling online through. We've only just started that, but we've now also got a supply agreement with Chemist Warehouse, which was a tremendous coup for us. And they're not as big in China as they are in Australia, obviously, but Chemist Warehouse is a major growing brand in China, and they're now stocking our product on their shelves, and I'm sure that that's going to result in significant sales growth for us in China. In Europe, we only just started that sales in Italy, and it was a terrific first half revenue for us from a standing start into the Italian market. So that's been a good entry for us as well. Next. China is obviously the real focus for us at the moment. It's a tremendously huge market. They like these type of products. We've made some key appointments, as you can see, with Stephen Turner, Vicky Howe, and Linda Liu. These people have great connections into the Chinese market. We're leveraging off that. We are investing in our expansion to the Chinese market. That is going to hopefully pay tremendous dividend returns for us. And we are going all on in terms of putting ourselves into China. Part of that strategy is actually having the product which is manufactured in Ohio, but actually being manufactured and packaged in New Zealand. So with these sales that are going into China, you'll actually have a New Zealand one. Now, I would have liked to have seen an Australian packaging and manufactured here, but clearly, based on the geopolitical politics, that sort of idea got kiboshed. But New Zealand is still a great option for us. And I think it's going to be a tremendous entry into the Chinese market for us. And I think that's what investors should be looking forward to. Next. So we've got 3 pillars of growth strategy. Obviously, we've got our products. The products are expanding in terms of a platform of products. There's also a strategy behind that. Who's the biggest player in the nutraceutical space? It's actually Nestle. Nestle are huge, and they're very interested in this sort of space, and I'm certain they'll be very interested in what we're doing. So one day I would hope that we could look for a trade sale to the likes of a Nestle once we've actually established ourselves and show that we are gaining attraction with customers. Then you become ripe for a takeover. So that's something we could be looking forward to at some point. It's obviously expanding into new territories and using new sales channels, obviously not just being online, but also being available on the shelves as well in retail outlets. Next. So just finally, we're executing on this 3-pillar strategy. I've pretty much just described these points here, but clearly there are exciting new sales opportunities for us through the expansion into those new territories, the new products, and also going into different sales channels. That's what a shareholder's money has been used for. And we're keen to actually deliver continuing strong returns for our shareholders. And next. I'd like to thank everyone for your time. And Tim, I would be happy to take any questions.
Thanks, Brian. That's really of interest. Can we go back a step? And there's a question here. Are there longer studies that confirm that the accelerated growth leads to resilient skeleton outcomes and no adverse findings? Really good question.
Yeah, look, it isn't a good question. It's not one I can actually answer with any great knowledge, because the clinical trial that we did was a 12-month study. So I have been asked regularly, what's going to be the effect long-term on children who are taking it greater than 12 months in terms of that. And I don't have the data. I'd like to think that these kids end up being taller than what they would otherwise destined to be. I can't answer that though. But sure, certainly it is healthy for them, and it does accelerate their growth.
And is there any lessons to be learned from the experiences of like A2 Milk and Bellamy's in terms of their pathway into China?
Look, we have actually got new staff that have that background, and so we're taking advice from them. I think the fact that they are Australian companies may in fact be the biggest problem with their entry into China, just because of the geopolitical thing, and I think we were smart to go for New Zealand. So I don't see any hurdles for us. We're not an Australian company. We are an Israeli company that happens to be listed on the ASX. So I think that we shouldn't see any roadblocks in front of us in terms of getting to China.
And you've got great gross margins and strong sales growth. What's the timeline to be cash flow positive, and what's kind of cash burn at the moment? That's a question.
Well, right now we could be cash flow positive if we chose to be. So, but we're not. The reason why we did that recent capital raise is because we are investing in marketing. That's what we are. So we're investing heavily in marketing so that we can grow those sales channels and performance. And I think that that's what's going to pay big dividends for us going forward. We do have strong margins, which is important to us. But, at some point, I expect that we'll be a dividend-paying company. I mean, maybe within the next year or two. But, I never know. I mean, I'd like to think that some big suitor would come along and take us out before we even have the opportunity to pay a dividend. That would certainly be good for my exit.
Sounds like a good exit. And the sales channels into China, can you give us a bit more colour on that? Are they the likes of Alibaba and those big platforms?
Well, we're actually using Tmall Global, which is equivalent to Alibaba, and obviously we've just announced the sales through Chemist Warehouse. So we've got that two-pronged strategy, and we also have an influencer campaign. There's a kid who's actually an influencer in the Chinese market. He's been memed, his meme has been shared more than 1 billion times. So he's actually become the face of the company in China. So there's a three-pronged strategy with the influencers, the online sales, and also now into physical sales. And that's what we think is going to get us to success in China.
And finally, when do you expect those Chinese sales to kind of start?
They should be starting this quarter. So we should be seeing performance on that in the first quarter of next calendar year.
Great, Brian. That's all we have time for. We always appreciate your time. Thanks for coming back, and have a good weekend.
I appreciate it. Thanks for having me.
Thanks, man. Next up, we have First AU, ASX code FAU, market cap of only 8 million. Stocks had a 1-year return of -30%. The company is an Australian-focused exploration company with exciting gold and base metal projects in Victoria and Western Australia. We have with us the CEO, Ryan Skeen. Ryan, over to you, mate.
Thanks a lot, Tim, and thanks a lot for everyone for jumping on board for a short presentation today. If we could jump straight to slide 3, that'd be great. You can go back to the disclaimer in your own time. Just a summary. So we've got assets across Victoria, South Australia, and WA. And Victoria is our primary exploration focus at this point in time. And we've got our 3 primary targets being the Snowstorm, Hornet Stream, and Dogwood, which is copper, the other 2 being gold. We've had some early success in our first drill program at our Snowstorm prospect, producing an intersection over 30 grams per tonne, which is greater than an ounce, which was really, really encouraging and something that got us really excited. And then we have our WA-based Gimlet project that has got 120,000 ounces of gold. And then our recently announced Mabel Creek, which is an iron oxide copper gold prospect, which we will look to start some exploration on over the coming months. Next slide, please. Company summary. As Tim mentioned, we're currently at a market cap of about 8.5 million. I think that it probably, from our point of view, I think it's a fantastic time to start looking at us as a company. We've got some great projects. We've got a lot of exploration coming up, and we certainly think that we can deliver some strong results. We're pretty well funded around that 2 to 2.4 million for now. And yeah, we'll go to the next slide, please. Board and management, we've got a fantastic team. We've got a lot of experience. We've got some guys that have been behind De Grey Mining in the founding of the company, Atlas Iron, the chairman of Westwoods Mining. So we're well positioned in terms of our corporate governance and experience in mining exploration to deliver results. Next slide, please. Our technical team, I think we're really lucky with the guys we've got on board. And part of it is that these guys pegged the ground that we've got. We certainly think that it's something that differentiates us in terms of the quality of our geologists and our geological consultants. Next slide, please. So just very briefly on why we're in East Gippsland and why it's our primary focus. As we can see on the left-hand side, that initial image that our Hornet Stream or the East Gippsland Gold where we're placed was initially in line with Bendigo and Fosterville and Stawell, which has produced very significant amounts of gold. And then there was what's called the Tasmanian indenter came up and hit Victoria, and that's caused the bending of the what now looks like a Z, and that's what we believe has moved our prospects over to there, and that's what brought us to that area. Next slide, please. I think that one of the really unique things is that, looking at some of the rock chip samples that our geologists have been able to take. So, for example, we can see that there's 123 grams per tonne rock chip taken at Snowstorm. That's literally a case of our geologists walking up to, rocks or outcrop and taking samples from that. And I think that the historical production and the historical mining in the area, which hasn't been followed up for a long period of time, tells us that there is gold where we're looking. It's just that no one has gone and done the work at a deep level to be able to find it at this stage. And we believe that we're going to be able to, and our results are certainly starting to indicate that. We recently announced our Dogwood prospect as well. I think it was on Wednesday that we released that to the market. This is a really interesting one. It's been drilled previously back in the mid-90s and produced intersections up to 1.33% copper, which is really, really good. So that's something interesting and exciting that's coming on and will increase exploration over the next few months as well. Next slide, please. This is just a graphic of where we're located in Victoria. So we can see that we've got a really significant land package. I think in total where it will be at about 2,250 square kilometres by the end of this year, with some tenements that are going to be granted. At this stage, our Snowstorm tenement and Haunted Stream are the two that have been granted, but we've got these other surrounding ones which will be before the end of the calendar year. Next slide, please. So Snowstorm's our most advanced prospect to date. As I mentioned, we've had some really good rock chip samples in our initial field work, but then we've also had our initial maiden drill program finish up around June this year, and we delivered some really good results. 3 meters at 11.6 grams, 1 meter at 8.5, and things like that. So I think that we didn't get a really strong reaction from the market, but I think have to remember this is our first time drilling this ground, and we got a lot of information which is going to be really useful for our current drilling program, and these types of grades are really quite significant. So we think that in this current drill program, which has actually commenced as of yesterday, so the drills started turning yesterday, we're confident that we're going to be able to deliver further results and really strong results at this prospect. So the two primary targets that we're focusing on can be seen here. So it's going to be based around the hole 2 from the last program, which delivered the 33 gram intersection, and hole 5, which also produced the 8.5 gram section. Next slide, please. Our Haunted Stream prospect, I think this is the one that we're really looking forward to increasing our work on over the coming months. We can see some of the numbers, and if you have a look back at the historical mine production in this area, that ore being extracted at 15 to 30 grams per tonne and above is really high grade stuff. And we can see that we've got a significant land holding here. With that image, the strike zone goes for about 8.5 k's. Our initial priority is going to be down the bottom there, where we can see the Orenstein and Hibernia, and that's where the historical mining production has been over that 30 grams per tonne, and we think presents a really good opportunity to deliver some strong results. With that, we have got a work plan submitted to the ERR, which is Earth Resources and Regulation, and we're just waiting on that to come back for approval. Once we've been approved on that, we'll be able to look at getting a drill rig organised and start our exploration works there. Next slide, please. Dogwood, as I mentioned, this is a copper prospect. So it was initially discovered by Anglo-American Prospect in the 1980s and last drilled by CRA in the mid-90s, which is now owned by Rio Tinto. Obviously, the copper price in the mid-90s wasn't quite as high as what it is now, and we think that it presents an opportunity to deliver some really good value for the company and the shareholders. Some of the intersections, like I mentioned briefly before, 13 metres at 1.33%, 30 metres at 0.5%, which included 8 metres at 1.2, and then there's also been some good gold intersections as well, 2 metres at 8 grams per tonne. So our initial plan with this is that we're going to replicate the initial exploration works that were done by CRA, but plan to drill them at a further depth. What we can see in this chart here, that line that runs on an angle and finishes in the yellow zone, is actually the intersection which produced the 1.33% copper. And what it's showing is that it actually ended in mineralization. So what we want to do, and similar to all other holes, is that we want to drill deeper to test mineralization at depth and see how much further it can go. The tenement is not granted at this stage, but we expect it to be in Q4 this year. And we're pretty keen to commence exploration and drilling on that relatively soon after that has been granted. Next slide, please. Mabel Creek. So again, we've got a really good land package here in South Australia, not too far from Coober at just over 1,000 square kilometres. This project was actually found by one of our geologists, Dr. Gavin England, who was following a South Australian government initiative where they ran a competition to encourage the increase of exploration works in South Australia. The winner and the runner-up actually identified the ground or areas overlapping the ground that we've got as highly prospective for gold and IOCG deposits. And the ground was free, much to our surprise. So we've pegged that ground. We've now got the tenements granted, and we'll be looking to start working on those over the coming months. We can see that we've got some pretty good neighbours in BHP, Rio, FMG, and Oz Minerals. And we're looking forward to seeing what this project can deliver, but we think we've got something good here. Next slide. Lastly, we've got our Gimlet Gold project in WA, in the Kalgoorlie area. It's got an existing resource of 120,000 ounces. We've got a mining lease application underway. That's with the WA government. We will continue to peg away at that, and hopefully that'll be granted soon. But we've also identified some further targets on the ground as well, that we can look to do some further exploration works on over the coming months to increase the prospectivity of the site. Next slide, please. So just a quick summary. We've got drilling going on up at Snowstorm at the moment. That's going to be ongoing for the next few months, but we expect to be able to periodically release some data and some assay results from that. We've got granting of further tenements in East Gippsland, including the Dogwood porphyry copper prospect. We've got a LiDAR survey data to be released to the market in the not too distant future, which is going to give us some insight into further historical workings. And then we'll be looking to start undertaking some initial exploration on Mabel Creek in South Australia as well. I think that's sort of everything. And if we've got any questions, I'd love to hear them.
Yeah, thanks, Ryan. We've got one of our analysts online, so it'll be a little bit technical, but technical perhaps for our audience. But Victoria has some high-grade gold, but ore bodies and geological setting have been big challenges for small explorers.
Yep.
Is your targets, or are your targets any different?
No, I don't think so. But I think that's where going back to our technical team, and particularly Ian Nielsen and PGN Geoscience, that they are structural geologists, and they've been able to give us some really strong insights into the structural controls. And we think that we've got quite a good grip on that. And I think that, as the chairman likes to say, when the lie detector goes down, we'll get a pretty good answer as to where we sit with that. But we think our geological team and the insights that they're able to provide put us in a position to understand the structural controls of the ore bodies. And look, for the analysts, I'd be more than happy to take this conversation offline and go into a bit more detail if that's something that you'd be interested in.
Sure. And with plenty of interest in the kind of EV battery space at the moment, are there plans to accelerate your copper development at Dogwood?
I don't think there's plans to accelerate. I think it's already, a relatively interesting prospect, and it's something that we're already looking to work. The granting of the tenement, we can't do anything more about that. As I mentioned, once it is granted, we are very keen to start doing works on it. The fact that we've already released some information to the market, we're starting to undertake some field work, some structural mapping. We've identified our drill targets, all those sorts of things. I'm pretty confident saying we're well positioned to get started once we can.
And what's the access like to drill rigs out there? We always ask that of, miners out in Kalgoorlie, for example.
I think it's probably the same as everywhere, that it can be challenging getting access to drill rigs, but I think that, if you're getting on the front foot, getting out there and organising in advance, you can get access to them, but it can be a challenge at times. And I think that, once you've got a drill rig, possession is 9/10 of the law, and you've got to make sure that you keep drilling.
And sorry, there's a question, it's not for here, but and so working capital is always a balancing act. What are your plans moving out in terms of your drilling program and access to capital?
Look, I think that right now we're in a reasonable position to probably go, another round of drilling at one of our prospects before we need to consider that. I think that we've got the ability to raise the capital if we need it. I think we've got a great suite of projects and some great prospects. But I don't think that it's something that we're thinking of at this very second. It's certainly in the back of our minds, but, I think we're well placed for now.
Great, Ryan. That's all we have time for. Great to hear the first AU story, and we'll get you back on again. Thanks for your time.
Fantastic. Thanks, Tim.
Next up, finally, we have Zoom2U Technologies, ASX code Z2U, market cap of $97 million, 1 year return of -16%. The company helps provide customers with faster deliveries and complete transparency. It removes the frustration of having no transparency or control over your delivery. We have with us Steve Orenstein. Steve, thanks for your time. Over to you.
Thanks, Tim. Great to be here, and thanks everyone for your time today. I'll just maybe head to slide 3. Here we go. Just to give you a little background on myself. So I'm the founder and CEO of the company. The company started about 7 years ago. And prior to starting Zoom2U, I was running another business called Connect to Field. So Connect to Field is a job management and scheduling application. So it was a SaaS application. We had customers right across the world. So I've got a lot of experience in technology, building SaaS products, but also in that logistics space as well. So post that business being sold, so I got acquired by a company out of the US called Fleetmatics at the time, which was listed on the New York Stock Exchange. I then saw an opportunity to look at building a platform that would enable some real transparency around the delivery of fast deliveries. And with that, we started building Zoom2U, and today, we've got over 8,000 drivers on our platform, completed more than 2 million deliveries. So I'll just switch ahead to the next slide. So the three main parts of our business is Zoom2U, Locate2U, and then we've got a smaller business called 2U Enterprises. So the two core parts has been Zoom2U and Locate2U. And Zoom2U, as I mentioned earlier, is this marketplace connecting customers to drivers for fast same-day delivery. We've been operating this now for 7 years. We've got loads of customers. So there's over 50,000 customers on the platform that have placed that delivery. And those customers are made up of sometimes just individuals or small businesses, but also some really large enterprise businesses that I'll touch on shortly. Locate2U is a new product, and that's our SaaS platform. And this now has over 60 customers. It's used by any business that's running their own fleet of their own drivers. So you think about any business that's doing logistics and they're managing those drivers and trying to figure out which drivers are going to be doing which deliveries, but also letting their customers know when those deliveries are actually occurring. Locate2U is perfect for those businesses. I'll touch on who they are as well. So 2U Enterprises, this is a part of our business that we use to test and experiment with new technologies and new concepts. And today we have a business in there called Shred2U, which is just for document shredding. We don't do any of the physical document shredding. We're using a third party that does the document shredding. So we're just a technology platform in that play as well. So we're a technology business running a number of different platforms, but the two key platforms is Zoom2U and Locate2U. So I'll just go to the next slide. So center to both of Locate You and Zoom to You is the customer. And this was the whole concept in building this business, was around giving customers a better delivery experience. And that's with that live tracking that you can see there in the middle. So when a delivery takes place, you can see the live location of your driver, you can see the estimated arrival time, and you can communicate with your driver. And so the whole thing around this was, how do we remove that frustration in customers knowing when the driver is actually arriving? And I think everyone probably on this call today has experienced, a driver arriving, not having to, not actually delivering the parcel, going to the post office to pick up that parcel. This solves that by giving that customer a much better experience in being able to track that live location. We use a lot of technology to run this, which we've all built internally. We do route optimization, SMSs to the customer, SMS on completion, and being able to get the rating of those drivers throughout that. So if you're running your own fleet of drivers, you're using Locate to You. If you're looking to use a network of drivers and using our network that we have on the platform, then you're using Zoom to You. We make money in different ways. So on the Zoom to You business, we make it by charging a transaction fee. That transaction fee will be charged to the customer, but also to the driver. And we create a relationship between the driver and the customer to actually process that payment. On Locate to You, we make our money through a monthly recurring subscription that varies depending on the numbers of users. And that could vary from less than $100 right through to thousands of dollars, depending on the type of business and whether it's a small business right through to some really large enterprise customers. Generally it's on a monthly subscription. In some instances we'll be on a month-to-month payment, or in other instances it'll be on a 12 to 24-month contract. Sorry, go to the next slide. So just to touch on the opportunity that we see, and Zoom to You is very much focused in the Australian delivery market. So it's an over $5 billion market, lots of opportunity to grow into this market. We think there's a lot of opportunity with really big players that can be disrupted, and we're seeing that through the customer inquiries that we're receiving. But also from a Locate to You point of view is providing this last mile delivery software to a global customer base. Today we already have customers throughout the world. We only launched this product, Locate to You, in the last year, and we have customers throughout the US and Europe and New Zealand and also in Australia. So we see this market as growing. There's lots of opportunity as people are moving towards faster delivery and e-commerce, but also the impacts of COVID as well. So you think about now, particularly in lockdowns and particularly in the Australian market right now, there's increased use of delivery. But what that's also done is it's created this shift in terms of people now using e-commerce and actually purchasing online and now experiencing more and more delivery. And e-commerce vendors now really value the delivery experience. Next slide. So just a snapshot. So we've had a large number of customers that have used Zoom to You. We've got a large driver network, and that driver network is made up of bikes, cars, vans, right through to some full load trucks of semi-trailers. The platform operates 7 days a week, day and night, and can move anything from an envelope right through to that full large truck of freight. We've won the Product Review Award for the last 3 years. And so if you're interested, have a look on Product Review, do a search for Zoom to You, and you'll see the types of reviews that we get from customers who've used the platform for delivery. Our delivery is typically always on the same day, and so it's always a faster delivery. And it's about providing that simplicity and going to our website, signing up, getting instant access, and actually being able to place that delivery and then being able to communicate and track your driver live. Next slide. So from a customer's point of view, they go to our booking portal. Anyone here today can go to zoomtoyou.com. You can actually sign up instantly. You'll get access to actually place that booking. The moment that booking actually gets entered into the system, it'll automatically get dispatched out to the network of drivers. So the drivers have an app on their phone. They'll see a pop-up on their screen for a booking that arrives. It'll tell them the value of that booking. The drivers will choose to accept or reject that booking. In our model, it's an algorithm doing dispatch, and it's automatically knowing who the closest driver is. And so we've built the technology to really streamline this process in doing dispatch and making sure it's as optimized as possible. From the customer's point of view, they'll get a tracking link. They can click on via SMS. They can see the live location, and then they can actually rate that driver and the completion of the delivery. Next slide. So we've been running now for 7 years, and the business has gone through some really great growth over that time period. And we've completed more than 2 million deliveries that have been processed through the platform, and we've got some really big customers on board. DHL is one of our customers. Nespresso is another. Telstra more recently is just another one as well. If you go to the Nespresso website, and as you go through the checkout process, you'll notice that Zoom to You is available as a delivery option. So if you're wanting your coffee delivered today, you can go to Nespresso, you can book it in a 3-hour time window, and you'll know you'll get your coffee delivered on the same day. They'll also use us for their slower deliveries. So in the instance where they'll actually consolidate a number of bookings, instead of sending it through Australia Post in metro areas, they'll actually push it through the Zoom to You network. So Nespresso is a great example of a retailer leveraging their retail footprint. And I think there's a real shift that's happening with retailers being able to leverage their retail footprint, which is really close to the customer for that faster delivery. So a retailer in general has a bigger advantage over e-commerce business. The e-commerce business generally has their warehouse in the middle of nowhere. It's really far away and it's really difficult to do a fast delivery. Whereas a retailer is really close to the consumer and you can get a delivery completed within 1 to 2 hours. Recently launched with Telstra. If you go to telstra.com/same day, you can actually go through the process of ordering your phone, having it delivered within 2 hours. That only recently just went live. Today, if you wanted to order your iPhone, which just got launched today, you can go to that site and actually call the Telstra store and have it delivered within 2 hours. And it's a great example of retailers using the platform to really provide customers with a better experience. As you can see, we've had consistent revenue growth over the years. And what we are seeing now is, over the last 7 years, we spent a lot of time in building our technology and building the platform. Now we've built that. Now we're seeing some acceleration in revenue growth, and also with COVID, seeing retailers really interested in pushing a same-day delivery model. Next slide. So touching on now, Locate to You. So Locate to You is the SaaS platform. This is a newer part of our business, and it's got over 60 customers using the platform. And this enables any business that's running their own fleet of drivers to do things like route optimization. And so what that means is if a company has 100 deliveries to do in a day, the system will automatically build that route and tell them the most efficient way to do that. So it's a real cost saving for that business, both in time and organizing, but also in enabling the most efficient route to actually do those deliveries. What's really important with route optimization is that then you can enable to share a link to your customer, and the customer can actually see where that delivery driver is. We do things like proof of delivery, so capturing a signature on completion, SMS alerts, and also being able to capture reviews, so you can see a star rating on completion of those deliveries. Next slide. So from a driver's point of view, we make it really easy. So if you're a driver and you're starting at a warehouse to go and pick up 100 deliveries to do today, it's really challenging to actually figure out which delivery to actually do first and how to actually optimize them. In the instance where you're using Locate to You, it populates into their app. It lists them in the most efficient order of the route to actually do them, and they just need to follow that route. It shows them on the map. You can see that there, and it makes it really, really easy for that driver to actually complete it. So we're enabling drivers that have no idea where they're driving in the area that they are to be as efficient as someone that's been delivering in that area for many months. And we see this being really useful for really large organizations. And we're seeing this also, with the work that we do with DHL, where, they could be using a number of drivers on our platform on a regular basis. Let's go through to the next slide. So just a couple more case studies. Binglee, if they're obviously a retail store in Sydney, if you need to order something that's relatively small, you can order it through their website, have it delivered through Zoom to You on the same day. So it's a really great way of being able to get product to consumers really, really quickly. Next slide. And the next case study here is a Locate to You case study. So Amart Furniture, it's our first enterprise customer that just recently came on board. They've got 150 drivers that they're now using to actually use Locate to You to manage all those drivers. And this is enabling them to actually give their customers a better experience. So the key thing for them was around, they don't want to tell their customer they're going to be there between the AM or the PM, between a really large time window. They want to send a text message to that customer with a link they can click on and enable that customer to actually see the live location of their driver arriving. And so it'll do that at the moment that driver actually leaves the depot. So it's a really great way for their business to actually improve their customer experience. But also operationally, they can actually now optimize the route of those deliveries. So they don't have to sit there and spend 6 hours a day working out hundreds of deliveries to do the following day, their system will do that within minutes. That's a really great example of use of our technology. Next slide. There you go. So happy to answer any questions that anyone might have.
Thanks, Steve. You mentioned DHL, and I was going to say or ask, do you compete with the likes of DHL? But you mentioned them being your client, your customer. How does that work? How do you work with a competitor?
Yeah, so I mean, DHL is not necessarily a competitor to us. We're operating in the same day delivery space. They're doing the international freight, and so they're bringing freight into Australia. They have a last mile requirement where it's the delivery from the depot to the consumer. And particularly around that consumer delivery, we're able to do that much, much more efficiently than what they're able to do that, and be able to assist them in dealing with spikes in demand. And so in their business, they'll see rapid spikes on certain days of the week. So the weekend, they're not delivering. Monday, they see a massive spike. They're able to leverage our network to really scale up the numbers of drivers and to clear freight really efficiently. But also using that route optimization technology to actually make sure that the drivers they're using, who are on an ad hoc basis, are able to do that efficiently and know sort of the most efficient route to get to their customers.
And so who are your competitors in this kind of same day delivery network?
Yeah, I mean, look, you've got the likes of Australia Post, you've got Toll, you've got a lot of the traditional players. And these players were all designed to deliver to B2B. They've only switched to having to deliver to consumers with the likes of e-commerce becoming available. And so their business model doesn't really allow them to scale up and down like our business model does. And so, yeah, it's great to be competing against, some really large incumbent businesses there, and we see a big opportunity to compete against them.
I mean, Australia Post is obviously an issue in itself. It's been at capacity, had to kind of close its doors to deliveries. And then there's a question here, what's the impact of this kind of recent strike? I think it's just in Victoria, isn't it?
Yeah, look, I mean, I think they've had a number of issues around capacity, and it couldn't be better for us. It's a great time for our business where we're able to really take advantage of, the COVID and increased deliveries, but also, existing players not being able to cope with increased demand. So it's a really, really positive thing for our business.
And is kind of Uber a competitor in this space? I think there's another one, is it DoorDash, where, anything and everything can get delivered?
Yeah, I mean, generally not. I mean, we're doing everything from an envelope right through to a full truckload of freight. And so, customers that we're speaking to and the retailers are wanting to be able to do that entire amount. Also, our drivers will actually park the car, actually go inside to actually do those deliveries. Their models, they're not doing those types of things. And what we're knowing is from speaking to the retailers and e-commerce businesses is that because we specialize and we've built our own technology, that really enables them to have a better experience. And it's when you start getting into the detail that they start to realize the real benefit that we offer.
And there's some really impressive revenue growth there recently. Can you talk to what your margins are and whether you're profitable?
Yeah, so the business isn't profitable to date, and for the foreseeable future, we're really focused on growth, and we see there's a big opportunity to grow Zoom to You in the Australian market, but also locate to You in a global market. And so we'll be really focused on growth. We've got sufficient capital to get us through over the next 2 years. We may look to consider to move towards a positive EBITDA, but for right now, we're very focused on a growth aspects of our business.
And I appreciate there wasn't much time, but can you give us a bit more colour, say, on Bing and how you get them as a client, what they pay, how does that flow through to the consumer?
Yeah, so in an example like Bing, you go to the Bing website, you place an order. You'll also be able to select Zoom to You as a delivery option, the same way you're doing that for Nespresso and others. Bing has an arrangement with us where they'll pay us for each of those deliveries. And that fee may be different to what they actually charge the consumer. In most instances, e-commerce businesses, retail are actually subsidizing the delivery cost. And so, there'll be a charge that's charged by the driver. It might be a $15 delivery fee or something in that region. We typically take a 20 to 30% transaction fee. The rest of the money goes to the driver.
And where do you see your next stage of growth coming from?
I mean, definitely, right now what we're seeing is there's lots of interest from retail and e-commerce businesses. We attract, consumers and small businesses that use our platform, but the real sort of growth aspect for us is, onboarding these large e-commerce businesses and retailers. And there's, substantial opportunity in that space. So it's a great time now. What COVID has done for this business has been, really exciting because it's made retailers really think about delivery, and they know that having a good delivery experience will mean that there's going to be a repeat purchase. from those consumers.
And there's questions here around, do you employ the driver? Are they a contractor?
Yes.
You own the cars and the vans and...
No, so we're a technology business, and so we operate Zoom2U as a platform, and so the platform is connecting the customer to the driver, and that relationship builds a relationship between the customer and the driver, and we act as a platform charging a transaction fee. So we're an asset light business, very, very scalable and completely technology focused in sort of building out of our technology.
And how is that kind of reporting back to the client technology differ from what Australia Post does or something like that?
Yeah, so it's significant. Just go to the Australia Post website, try and book a same-day delivery today, and then try doing it on Zoom2U, and you'll see the difference. You can go to our site, you can instantly get access to it within seconds, you can place a delivery within seconds, but then you've got the full, complete visibility of seeing exactly who your driver is and being able to communicate with your driver and being able to see that ETA. On completion of that delivery, you'll get live proof of delivery information. You'll see the rating that comes back as well. So you've just got real visibility over that platform. And it's a platform that we've built from the ground up, and we've learned a lot from customers over the years. It's not that we started today, it's 7 years ago, and there's 7 years of that journey that we've been building this platform and learning, and over 2 million deliveries have been processed in this time period. And so for me, it's a sales and marketing effort to really capture market share as we expand the business across Australia and throughout the globe with Locate2U.
Great, so really impressive story. I plan to be a customer, and you've probably got a couple of hundred new ones today. So thanks for your time, and we'll look out for this story moving forward.
Perfect. Thanks, Tim. Thanks, everyone. Appreciate your time.
Thanks, everyone. That's all we have time for. Enjoy your weekend. We'll see you next week.